Well, why don't we bring in Jay Taylor? Jay is the president and CEO of Taylor Hard Money Advisors, and he joins me now live on the set in Singapore, usually based in New York, but over here escaping the cold, I presume.
Indeed. I hear we're having some record cold temperatures coming. My wife tells me this morning.
Okay. Why don't we talk a bit about gold? We were chatting in the break, Jay, and you said that you see considerable deflationary pressures building in the market, but yet you're still bullish on gold.
Well, indeed, and I think it's important to look at gold not in nominal terms, but in real terms, because the price of gold, what an ounce of gold will buy, is much more important than the nominal price. If you go back to last fall, after the Lehman Brothers collapse, after a few weeks or months afterwards, an ounce of gold would have bought 6 times more oil than it bought before the Lehman Brothers collapse. It would have bought 2 or 3 times more copper. It would have bought 2 or 3 times more of the Rogers Raw Material Fund. An ounce of gold would have purchased. It increased its purchasing power very dramatically. And that's very significant for the mining companies and the profit margins for mining companies. And we did start to see some influence in the mining company, the gold mining company profit margins, because the price of the commodity, or the price of the metal they're selling was relatively high compared to the cost, and labor became very plentiful also for the mining companies because the base metal mines were shutting down. This at least was true in North America. In Canada, for example, the base metal mines were shutting down and there was plenty of labor. I know many of mining companies that told me they had a heck of a time finding good labor during the hot times for the commodities, but once the pressures broke, once the commodities fell, once the markets tanked, it was easy. They had piles of resumes on their desk, and so those are some of the factors. I'm really bullish on gold mining, mostly if we have another occurrence of what happened last fall.
Jay, the overriding theme governing the gold market seems to be dollar depreciation. We've seen that very strong inverse correlation. That said, though, if we do see a turn in the US dollar, a rebound, that could undo this rally. What are your expectations? What's your call on the dollar? Is it in for a structural decline?
Well, yeah, I think long term it is. But again, I also think that we could be ready for a major equity market decline. My view is that what we saw last fall was the first leg down in a very severe bear market. And what we're experiencing now is a respite, a natural bounce off of that initial decline.
So the Dow 10,000 carries no weight with you whatsoever?
Well, it's psychological, but I think we could go a little higher yet, maybe 5% higher before we see the end of this B wave up. And then the C wave down, I hope we can hold the March lows. If we can't, I think we're in for something very, very severe on the downside. And if that happens, then what happens to gold? Well, I think the price of gold, again, in nominal terms, could go down, but in real terms would most likely go up. And we have a lot of precedent for this. In the 1930s, when we had this huge deflationary wave across the globe, gold mining companies did extremely well because the price of the gold remained high relative to the cost of producing it. And in fact, you can go back over, an analyst out of Vancouver named Bob Hoy has tracked 6 major credit expansion, credit contraction cycles. The first 4 were UK-centric and the last 2 US-centric. And of those 4 cycles, each and every time the credit expansion went into a contraction, the real price of gold went up very dramatically. So I think that my expectations, if you look around at the economy in the U.S., and I'm sure I'm a little bit biased, living in the U.S., and even as I come here to Singapore and start to sense what's going on in Asia, I realize that things aren't so desperate around the world. But back in the States, jobs are not being created. The bank loans, I think their portfolios are not really being cleaned up. There's a lot of problems yet. The real estate market has not bottomed out, I think, in the U.S. There's a host of municipal governments are having all kinds of problems there. So, I think that we could have another wave down, another leg down, very severe one coming up. And if that happens, it's going to have a lot to do with the dollar. I think the dollar then could get very strong.
Okay, Karen, jump in here.
Yes, Jay, before we let you go, I wanted to talk about the picture that's unfolding for some of the gold companies. Are both small and large producers enjoying this rally? Is it happening right across the board?
Yeah, I would say so. And again, some of those dynamics I was talking about where the cost of producing gold has actually come down is still in play. An ounce of gold will still buy twice as much oil, I believe, than before the Lehman Brothers collapse. So the equity markets and the gold producers, generally speaking, are doing very well.
Okay, well, we will come back to you in just a moment and continue our conversation. Jay Taylor, President and CEO of Taylor Hard Money Advisors, sticking around with us.